All right, so good evening, class. Let us begin. So we will continue from where we left off in session 5. And what we did, we looked at capital rationing. So now what we're going to be doing, we're going to continue the chapter on discounted cash flow techniques. And what comes next is asset replacement decisions. So that's what we're going to be looking at now, asset replacement decisions. Now, one of the first things is that let's look at what does this mean? Now, asset replacement decision, what it has to do is that, for example, you own an entity. Let's say you have a sales team that uses laptops or iPods or whatever they may use. Now, you have to have a policy to say, okay, we're going to replace these iPods or these laptops every 3 years, every 2 years. Maybe company cars, similarly, every 3 years, every 5 years. So you need a policy, a replacement policy, because you're not going to have the car until it's run down, where the manager is driving to a meeting and then the car broke down, right? You don't want that. So you want to ensure it in a condition that it's useful for a period of time, but these things do deteriorate and they do depreciate. Similarly, you don't want to give them a device. So let's say you're giving them a device, and this device that they're utilizing after 3, 4 years, it's outdated. Nobody else using it. Everybody uses more efficient methods, but you are not using an efficient method. So you need a policy. However, policies, no matter what it is, everything in life, many times is driven by cost, affordability. So, for example, you want a comfortable home. You want a reliable car. You want a fantastic education. You want the children to have pretty much everything that will allow them to excel in this life. You want all of that. You want all of that. That's fantastic. But the thing is, can you afford it? Can you afford your dream home? Can you afford your dream car? Can you afford your dream profession? Right? So that is something. Everything is driven by cost. Similarly, asset replacement decision will be driven by that as well. What is the most cost-effective method? So there are
Move
disadvantages to
on.
that, of course, because when
Bluetooth
your
mode.
technology is outdated, then that's a problem. But let's now
Pairing.
focus on. Hold on a second. Yes, there's
Mode.
somebody speaking. Okay, no problem. So I'll just okay. So for this now, we have to now determine if I'm going to replace the company car, what's the most cost effective? Is it cheaper to replace it every 3 years, every 4 years, or every 5 years? It may be cheaper to replace it every 3 years. You might be one asking yourself why, because guess what? The older the car, the higher the maintenance costs. So it might be cheaper to replace it every 3 years, or it may be cheaper to replace it every 5 years. Who knows? But that's what decision we're trying to make. So what are the steps? These are the steps, three main steps. Step one, calculate the NPV of each possible replacement cycle. What does that mean? If this car has a life of say 5 years, you're going to have to ascertain if I replace it every year, every 2 years, every 3 years, every 4 years, every 5 years. So when it says each possible replacement cycle, it means that you can replace your company cars every year. You can replace them every 2 years. You can replace them every 3 years. You can replace them every 4 years or every 5 years. All of that is possible, right? So that's what we're looking at. Number one, calculate the entry of each possible cycle. What we have to remember, however, is you may have information for the 5 years. So, for example, they tell you that it costs $1 million to maintain it in the first year is to $20,000. If I sell it after the first year, I can sell it for 800,000. And then in the second year, to maintain it, it costs 25,000. If I try to sell it, I can sell it for 700,000. Information like that. But it means if you're looking at a 1 year cycle, the only information important to you is the information for 1 year, mean the cost, the maintenance for the first year, and if you sell it at the end of the first year. Now, how about the second year? What is relevant? It's going to be the cost, the maintenance for the first year, the maintenance for the second year, and if you sell it the second year. Now, you notice I ignored something. If you're replacing it every 2 years, what you can sell it for at the end of year one is not important because you're going to keep it for 2 years. So the scrap value for year one is irrelevant, right? Because the only time you can sell something is when you're not gonna have it again. If you sell it at the end of the year, you put the scrap value at the end of the year, then you sell it. That means you don't have it for the second year. So that's just what you need to pay attention to. So number one, calculate the NPV of each possible cycle. Number two, calculate the equivalent annual cost of each cycle. How do you do that? Work out the NPV of the cycle and then divide it by the annuity factor for that period. So for example, I mentioned a 5-year replacement. What is the NPV if I replace it annually? And then I divide it by the annuity factor at the discount rate for year one. Similarly, what if I do it replace it every 2 years? What's the NPV for a 2-year cycle? Then I'm going to divide it by the annuity factor at the discount rate at year two, and so on and so forth. And then step 3, choose a cycle, the smallest annual equivalent cost. Because remember, these are costs we are assessing. When you're normally doing NPV, you want to maximize shareholder wealth and make as much money as possible. But when it comes to now replacement, it's the cost. You're going to choose the lowest cost, right? So that's what you're going to choose in terms of replacing the asset. So if it is cheapest is to replace every 2 years, then that's going to be the cycle you're going to choose. You're going to recommend that management replace the asset every 2 years. So here we have an example. So read it and let's go through. Right? So read it, then let us go through this example. Okay, so this one, the machine, it's possible to keep it can last for 2 years. So as long as the life is 2 years, it means you can replace it every year or every 2 years. So let's use the 2-year cycle. So it has, so we have a little template already. So now we have our time, we have our narrative, we have the cash flow, the discount factor, and they gave us 10%, 10%, okay, and the present value. Okay, all right. So we know right now, basically it's going to be pretty much with the purchase cost, right? Purchase price, cost, whatever, right? And we can pay, as it says, for the machine, which costs 20,000. So we pay 20,000 for the machine, right? Discount factor times 0 is 1, PV 20,000. That's good to go. running costs, we're gonna have to maintain it, right? We're gonna have to maintain it in the first year. And this one is the 1 year cycle, meaning it replaced every year. So we're gonna have to do as it says, step one is calculate the NPV of each cycle. That's step one. They calculate the NPV of a 1 year cycle, then the NPV of a 2 year cycle. Then step two, calculate the equivalent annual cost, which is the NPV of the cycle over the annuity factor for that particular cycle. And then step three, select the best, okay? Or the low, or lowest. Since it's two, the lower option. So running cost is going to be 5,000 for the first year. At 10%, that's 0.909. I think that's 4545. Okay, what next? Now, if it's a 1 year cycle, it means then that the running cost for year two is not relevant. You're even going to sell it after a year. So the scrap value at the end of the first year is what's important. That's an inflow. We're going to sell it. So after 1 year, we can sell it for $16,000. That's still 0.909, but we still can get the end of the first year. That gives us 14,544. When you do it, it's going to be a negative because it's a cost, and that's okay because we compare the lower the cost. Give you $10,001, right? So that's a 1 year cycle. So your NPV, $10,001. So we need to do now for a 2 year cycle. Same information, time zero, purchase, 20, so that part is okay, 20, that part is okay. The running cost for the first year, 5,000, 0.919, gives us 4545. Now, we don't sell it at the end of the first year, we're keeping it for 2 years, but we're gonna have to pay maintenance. So the maintenance cost now for year two is 55. And I think that's 0.826. That times that is going to give you 4543. Well, this was a cost, this was a cost, these are all costs so far. And then now, by the end of the 2 years, you can sell it, right? So year two, you have a scrap value, you can sell it. You can sell it for 13,000. That's an inflow. That's 0.826. That times that going to give us 10,738. And then when you do the sum total of it, the NPV is going to be at 18,350. 18,350. But don't bother make a decision yet. Because remember, we need our steps. Step two is going to be now. So step two. I'm just trying to outline how much of the code they are like. Perfect. I don't go outside of the I don't go outside of the screen. All right. So that's step one. Step two is no, we have to calculate the equivalent annual cost. So I'm using that word because it's annual equivalent cost, same equivalent annual cost. I want the interchanges in case you see the other word and then you want it, I never learned the same thing. Right? Annual equivalent annual cost, same thing. So I'm working on this. Step two is working out for each, which is the NPV of the cycle over the annuity factor. The NPV of this cycle is $10,001. The annuity factor at the end of year one, when you look at the annuity table for year one, you see 0.909. So that's what's going to be 0.909. So that means the equivalent annual cost is $11,002 for a 1 year cycle. Now, for a 2 year cycle, the equivalent annual cost, the NPV, 18,350, divided by the annuity factor at 10% for year two. The annuity factor, look on the annuity table, the annuity factor at 10%.
Excuse me, sir.
Yes.
Is it possible you could shift the camera a little bit? I'm not seeing the numbers clearly.
Which numbers you're not seeing clearly? All the numbers?
All the numbers.
Oh, well, just listen on. So, yeah, all right. So just, I'll just mention them again because you have the templates. I'll mention them again. And so that you can be utilizing the present value table. I want you to have that up so you can see where the numbers coming from. Right? So for the equivalent annual cost, so the first one, 1 year cycle, we pay 20,000. That's given. The running cost at the end of the first year is 5,000. And you can sell it at the end of the first year for 16,000. The discount factor, 10% for time zero, always 1. 10% for year 1 is 0.909. So you're going to have that twice, 0.909 twice. And then, of course, you multiply them going out. Multiplying them going out, you get an NPV, a sum total of $10,001 negative. It's a cost, and that's fine. For the 2-year cycle, purchase price remains $20,000. The running cost for the first year is $5,000. The running cost for the second year is $5,500. And the scrap value at the end of the second year is $13,000 positive. The discount factor at year 1 is 0.909 and at year 2, 0.826. You have it twice because the running cost year 2 and also the scrap value year 0.826. And that's a discount factor at 10%. Then, of course, you just multiply across and get the total. So when you multiply across, the total should be 18,350 as the NPV, sum of the present values. For the equivalent annual cost for year 1, it's 10,000 over 0.909, which is the NPV of year 1 cycle over the annuity factor for year 1. And the annuity factor for year 1 is 0.909. Now, regarding the 2-year cycle, the NPV is 18,350. The annuity factor at year 2 at 10% is 1.736. Again, use the annuity tables and you'll be able to confirm that. So make sure you have your present value tables with you, whether on the screen or printed, whichever one you prefer. And that is going to give you an equivalent annual cost of $10,570. What is step 3? Who is the better of the two? So if I replace this asset every year, it costs me an equivalent amount of $11,002. But if I replace it every 2 years, it costs me an equivalent amount of $10,570. So what would be the decision? The recommendation or the decision would be to replace every 2 years. That's the recommendation. That's the decision. Replace every 2 years. That's our recommendation. Because it's cheaper of the two, right? So our recommendation is to replace it every 2 years. That's our recommendation. And just for see if I can get up beyond that. There's something here. All right, and that's a better view. So that's a quick screenshot of the results of we just calculated. We're pretty much the same thing, just that we work out each line. And that really covers example 4. All right, so hold on a second. And as we mentioned earlier, we mentioned the limitation. We said that if technology changes, it might not be wise to wait too long to replace. Also, the requirements may change over time. You don't have use for it anymore. And there are other factors. Will your employees be satisfied with a company car that you take that you're replacing every 7 years versus other entities offering where the cars are replaced every 3 years? So those are other non-financial factors that should be considered. Now, the concept remains the same. All right, so the concept remains the same. So what we're going to be looking at here is this. If the concept remains the same for equivalent annual cost and equivalent annual benefit, we can work out 2 alternatives, and whichever one gives a greater benefit, we select it. All right, so that concept remains the same. So what we're going to be doing now, so for example, option one have a 4-year cycle. Work out the NPV for option one with a 4-year cycle. What's the cost? What are the anticipated savings or inflows? Discount them, work out that NPV, and then you work out the equivalent annual benefit, which would be the NPV over the annuity factor. And option two, similarly, with the cost, all the inflows, how many years is that cycle? And then, of course, NPV over the equivalent annual benefit, the annuity factor to get equivalent annual benefit. The one that's the better benefit, that's one we go ahead with. So I want you to try this one now. I'm giving you a few minutes now. I want you to try this one and let's discuss it quickly. You already have an outline, you already have a template as to how to work through it. So it shouldn't be a major thing for us because we already get a little outline as to the working. So the setup, pretty much the option one, cost 450, inflows year 1, 2, 3, 4. So it's a 4-year cycle. Option two, so two separate NPVs you're going to work out. The cost is 650, 5-year cycle, 1, 2, 3, 4, 5 inflows. Discount them at the recommended discount rate. In this case, it's 10% is given in the question. Discount them at the 10%, get the NPVs, then work out the equivalent annual benefit, and then let's make a decision or conclusion. Which of the machines is better, option one or option two? So I need you all to try this one out. Try this one, and then we will get into the lease question. So the video I shared with you all was regarding lease calculation. So hopefully that should take much time. So try example 5 now. Give you probably about 5 minutes. I don't think it took that long to work the question, this first one. So let's see. Let's give you about 5 minutes, and then we'll discuss example 5. All right, so not gonna take too long on this one because the principle remains the same. And I want this example really is just a repetition to see if we understand equivalent annual costs and equivalent annual benefit. Now, as we said, there are two cycles here. One thing we have to identify, we have two cycles here. So even though it's not replacing one machine, there are two options. And replacing a machine every year, 2 years, 3 years are options. So similar. You have two options. You have one project that can be for 4 years, one that can be for 5. You cannot invest in both. You try to see which one is better. Okay. So now option one, the cost is 450,000. The inflows are 200, 171, 30 a month. Option two, the cost is 650. The inflows are 222, 10, 180, 160, and 140. All these must be set out as we have our table, discounted at 10%, and then the NPV calculated for each of them. Once that is calculated, we're going to work out the equivalent annual benefit, which is the NPV of that particular option over the annuity factor. So for example, option one, the annuity factor will be the annuity factor at 10% for year 4. For option two, it would be the annuity factor at 10% for year 5. So that's it. Let's see what sort of numbers we would get. So the numbers are already there. So let's just switch out and I think I switched it. I switched. Still on that screen. Okay, not sure why it's still over there. Let me hold on a second. Yeah, it's green on. Sure. Okay. All right. All right. 1 second. Don't know what's going on. Let me stop the share and then reshare. All right. You can share again. So let me just try to get the everything back. Yeah, my connection was. So just came back. I was trying to share the screen and I don't know what happened. So all right, here we go. This one. All right, so for the equivalent annual benefit, we have the layout. So we have the cost in time 0, the inflows year 1 to 4, the NPV being $38,000. For option 2, we have the cash flows year 1, the time 0 is spent, year 1 to 5, you got some inflows. Discount them at the 10%, the NPV, 54,000. Remember that it's not done yet. That's just step 1. Step 1, calculate the NPV of both options. Step 2, calculate the equivalent annual benefit. That would be the NPV, each NPV over its specific annuity factor. For the 4-year cycle, the annuity factor okay, then why is this doing this? Yeah, for the 4-year cycle, the annuity factor for 4 years at 10%. For the 5-year cycle, the annuity factor at 10% for year 5. Then when you get those equivalent annual benefits, now these are benefits, you're going to use the higher benefits. So you realize that option 1 gives you a benefit of 12,000 annual benefit, whereas option 2 gives you an annual benefit of 14,000. So the better option for Barrel is option 2, because it has the higher equivalent annual benefit. Five. What we're getting into now is the leasing. Now, for the leasing, us, as we know that, let me just share this one. That's why I shared a leasing video for you to watch. So for the leasing, there are some steps, and we're gonna follow the steps and then work with these steps. We're gonna follow the steps and the example. But let's speak about the steps first and give you some time to do the example.
Excuse me, sir. Are you sharing your screen?
It's coming up. It's coming up. So
okay, thanks.
I don't know what the delay is happening with my screen, unfortunately. It's showing that it's not shared as it is. You have to see the answer though, right? So example 5.
Yes, sir.
Okay. Yeah, trying to share the leasing one, but realize it's taking some time. Not sure
it's showing now.
It's showing now? Okay. Yeah, it's showing for you now, but my screen is a little bit blank. I have to see it now. Perfect. All right, make that a little larger. It's a little bit too small there. Lease or buy decision. So now the company gonna have to determine, should we purchase the asset or somebody's leasing? I want that the leasing option is a better alternative. So we're gonna have to work on the NPV of purchasing the asset and the NPV of leasing the asset for the period of time that it's needed for. Because and then we're gonna declare. So one of the decisions the first decision we normally have to make is this project worthwhile? Are we gonna make any money from it? Then the next decision is we want the asset here. Let's determine, should we buy the asset or should we lease the asset? All right. So now let's look at what are the relevant cash flows. This is what we're going to be using now to do our calculations. If we're purchasing an asset, the relevant cash flows will be the purchase cost, the tax savings on tax allowable depreciation, or capital tax savings on capital allowances, and the scrap proceeds, the money you get from selling. That's for the buying decision. So you need those cash flow to work with the NPV of purchasing. For leasing, you're gonna know what are the lease payments, or what are the tax savings on the lease payments. But bear in mind that normally tax is paid in arrears, so you have to put the cash flows in the right period. Lease can also be paid in advance or in arrears. So if I have a 25-year lease and I pay in advance, I'm gonna have to pay from time 0 to time 24, right? Now time 1 to 25, I'm paying in advance, and I pay the first payment today. So it'll be from 0 to 24. If I'm paying in arrears, then it'll be from 1 to 25. So it's important to know the timing of the cash flow. Investment appraisal focuses a lot on timing of cash flow. So three key relevant cash flows for purchasing to work on the NPV, two main relevant cash flows for leasing to work on the NPV, and then if you look at the lower NPV, the better alternative. Is it to purchase outright or to lease the asset? So example 6 is yours to do. I'm going to give you about 8 minutes or so, probably give a few more. I need you to read the question carefully and try to work out this one. The operational benefit, don't worry about it. We'll discuss operational benefit. What I'm going to focus on is part B. Should you borrow the asset or should you borrow to buy, mean purchase, that first option, the one we have the three relevant cash flows, or should you lease the asset, the one that have the two relevant cash flows? So the layout is there in the tables already. So I want you all to focus and read it, check example, example 6. Work out the NPV of purchasing it, work out the NPV of leasing it. Now, they gave you the pre-tax cost of debt, you need a post-tax cost of debt. Meaning they told you using a bank loan at a 10.5% interest rate, but you know that the tax rate is 33%. So I want you to just work out, the 10.5% times 1 minus T, 1 minus the taxation. That is the post-tax cost of debt we need, right? So they work it out already, I tell you, the discount factor is 7%, But I want you to work it out in that space there to know how you get the 7%. How they got the 7% was the bank loan rate of 10.5% times 1 minus the tax rate as a post-tax rate, which is 33%. So go ahead, proceed to part B, please. I give you some time for that, 6-7 minutes. There. All right, so let's analyze the question and then get into the solution. The first part A, as I said, I didn't ask you to do it because really when I implement the project. Now, you'll notice in the question it says operating inflows are 150,000 for 2 years. That basically saying that they don't money they make, right? So they make 150,000 in year one and in year two. So an annuity. So it sounds like they're making money. All they have to do is work it after tax. So work the tax on the 150 each year, and then subtract that amount, and then you're good to go. Discounted at 10%. So that's for the first part. Well, what is important to know? It says the asset cost 200,000 on the first day. So we also told that tax is paid 1 year in arrears. So for example, the project returns will be year one and year two. The taxes, if it's paid a year in arrears, would be years 2 and years 3. So that timing is important. So they set up the table for you to do an annuity. But you have to remember that any annuity that does not include year one, it has to be adjusted. You can't just pick it up from the annuity table. So that's one. In terms of the cash flows that are relevant for the purchasing the asset, 100,000, the scrap value, 25,000, and also the capital allowances. And they said capital allowances, 25%, reducing balance with a balancing adjustment in the year of disposal. So you have to do your capital allowances to know how much it is, and then include it in your NPV calculation. And last but not least, leasing. The leasing, the relevant cost will be the lease costs and the tax on the tax savings on the lease costs, because every legitimate expense results in tax savings. Now, leasing an asset is a legitimate expense. So it's going to result in tax savings because you're spending money. But one of the point that they said is that leasing for 92.5 a year in advance for 2 years, meaning that you're going to pay in advance. So for year one, you're going to pay at the start, which is going to be times 0. And for year two, you're going to pay at the start, which is going to be times 1. So the lease payment is times 0 to 1, right? 0 to 1. So if it's 0 to 1, you can just look at the annuity table alone, because the annuity table only starts from year 1. So you have to add the discount factor for year 0 as well. And you know, the discount factor for time 0 is always 1. So we just add 1 to the annuity factor for year 1. And then it says that the lease payments are tax allowed. Now, if you pay at the start of the year, it's at the end of the year, you're going to see it in the book, which is year 1. And the tax is 1 year in arrears. So year 2. So the tax is on the lease payment. So even though you make the lease payments year 0 to 1, the taxes on the lease payment will be year 2 to 3. So that's just a quick overview of our discussion, but let's now go to the solution itself. Okay. So part A, as I said, we mentioned that in our discussion, but the one most important, the one that we're focused on is part B. So purchasing the asset, NPV, is 130,110. That's the NPV of purchase. And of course, the relevant cash flows, the purchase price, the sales proceeds, or the scrap value, and the tax savings on capital allowances. for the leasing flows, it's going to be the lease payments, 0 to 1, as we said, and the tax savings on the lease payments from 2 to 3, as we mentioned, right? Based on this information, leasing is cheaper than purchase. So we would recommend that they lease the asset, right? That the best financing method is to lease the asset. That's what would be our recommendation.
Sir, can you scroll up a bit before I come off the screen, please?
All right, hold on. Hold on a second. You want to say this? This is what we're looking at. What, this?
Yes, sir. Thank you.
You're most welcome. No problem. And as we said, based on the 2 NDVs, we would recommend that they lease the asset. Now, part C, I didn't tell you to focus on it. Part C is a consolidation. Part C is the NPV, the present value of part A, and the chosen option for part B to know what the overall NPV of the project would be. Right, and that would pretty much cover that exam. All right, let's move on. All right, and then it says evaluate using pre-tax cost of debt. So normally you evaluate using post-tax cost of debt. But if, for example, you're tax exempt, you're a charity, you have a lot of losses brought forward, so you're not going to really get any tax benefit, then you may use what may be more appropriate to use is without don't even take the take tax into effect because it don't really work out for you. It don't really make a difference to you. All right. So I want to give you all a few minutes to just do this example and we'll discuss it quickly. Same principle, but again, I think practice makes perfect. So I give you 5 minutes, not more than that. So attempt this example. So read it, attempt it, and then let's discuss it. Not exceeding 5. All right, so let's look at this now. So this one, it says the bank loan at 8% interest rate. They didn't bother to give anything about no taxes. As I said, the machine is required for a 3-year project in a tax-free high-tech car. So you don't need to consider taxation, and this is why I'm telling you that the principle remains the same. So should you purchase the asset or should you lease the asset? You have the information for the cost, the residual value, the repairs, the lease payment, whether it is paid in arrears or in advance. All of that information is provided. So it's really a matter of working on the NPV of each option and then choosing the lower of the options in terms of cost. So let's just quickly look at that and then wrap up this particular handout and actually get into session 6 handout. Now, session 6 handout is a very short handout. And that was mainly because we know that session 5 handout is a heavy handout and it would carry spill over to the next. So again, borrowing and purchasing. So it's 500,000 is purchase cost. The maintenance is 20,000 a year for the first 2 years. Year 3, you dispose of it in the 3rd year for 150. The discount factor being 8%. The cost of purchase for the present value of purchase is 416,560. If you're leasing the asset, no taxes to worry about, and you pay in arrears, so it's from year 1 to 3. Annuity factor at 8% for year 3 is 2.577. You get a PV of 412,320. The cheaper of the two methods is to lease the asset, right? So that's the cheaper of the two methods, leasing the asset. Okay, so in terms of wrapping up handout 5, let me just this. So in terms of wrapping it up, you're just looking at what is the impact on the financial statements. The good thing is in financial management, in this paper, you don't really need to know the difference between any operating lease or finance lease. The approach just remains the same. Coming out in IFRS in this paper. And that pretty much consolidates handout 5. Moving on from handout 5, we have a very short handout. And this handout wraps up investment appraisal and really speaks to risk and uncertainty, incorporating risk and uncertainty in your appraisal, when you're appraising your projects. Now, risk and uncertainty, again, there are two different, right? So, however, under investment appraisal, it's used interchangeably, right? So even though they might often have different meanings, only risk we can measure, uncertainty we can't measure. But again, means one and the same when we look at financial management. The first consideration relating to risk and uncertainty is that of sensitivity analysis. Now, what is sensitivity analysis? What is it really speaking to? Now, what it really is look at, okay, how much can something change and it would not impact my decision? So how sensitive is it? So for example, I know I have a project and right now I have a business and I'm making $1 million. What can change? And at least up to a certain point, and I'll still continue doing the business. Because as long as it doesn't make me start losing money, I will still go ahead. If we can make it, let's say $1,000, I'm okay with that. So that's what sensitivity is looking at. What change in a variable, what's the maximum change in a variable a project can accept before the decision changes? So it's known as what we call a what if analysis. So what if sales fall by 5%? Would you still do it? What if costs rise by 3%? Would you still go ahead? What if wages increase by 8%? Would this project still be viable? So those are some of the considerations. Now, the method for sensitivity analysis is this. Before you work out sensitivity, you need NPV. So calculate the NPV of the project first. That's the first step. Step one is to calculate the NPV of the project. Step two, for each element that make up the decision, for each cash flow that make up the decision, calculate its sensitivity. And how do you work it out? So it's going to work out as a percentage, mean what percentage can this cost increase by, and I'm still okay, mean at least break even, or what percentage can my inflows or revenues fall by? What's the maximum it can fall by? Before I decide that no, I'm not going to go ahead with the project. So this step two is work out the sensitivity of each. And when you get sensitivity, it is the NPV over the present value of the cash flow you're considering. So it is the NPV over the present value of the cash flow that you are considering, or the cash flow being considered. Right, so NPV over the present value of the cash flow being considered. All right, so let's focus on that. Let's try this now. So we have an example. And the example first they want us to do is that just say step one is calculate the NPV. Now we're going to do the sensitivity together, but I'm going to give you 3 minutes to work out the NPV. Yes, the template table is there already. So let's quickly work out the NPV. Let's discuss it quickly, and then we're going to do the sensitivity part. The NPV part, I'll be doing that already. The sensitivity you have. So let's try the NPV, and then let me do step two. Let's work step two together. All right, so some quick tips. Whenever you are doing sensitivity and you're at sensitivity of sales volume or sensitivity of revenue, majority of the time you're expected to work out the contribution. And you can use the contribution as the cash flow to determine the sensitivity of the sales volume. So you see the layout there and you're wondering why they put contribution. The reason why they put contribution, because contribution is useful when you're working on the sensitivity of your revenue or your sales volume. All right, so they didn't give you a contribution straight, but they told them this is the fund, they told you the cost. Well, they told the contribution, they did. They said generating a contribution of $2.75 per P. So the initial cost now, let's start it before we even get. So the initial cost, so his first project involves investing 150,000. So the initial cost in time zero is 150,000. This one factor 15%. You have one, and then that will give you your present value of 150,000 negative. The contribution now, if you notice, I put year 1 to 15 because it's an annuity, so 15 years. So you're not going to write that 15 times. So the contribution is $2.75 times 15,000. That's the contribution. That's what you're going to have as a contribution, the cash flow. Your fixed cost, 1 to 15, the same thing. You're not going to write that 15 times. They tell you that the fixed cost is 15,000 per annum. So you put 15,000 there. So that's another cost. So the contribution is an inflow. The initial cost is a cost. The fixed cost is a cost. And then the scrap value. You're told that you can sell it for 15,000. So this is another a different 15,000. And this 15,000 is an inflow in year 15 alone. So if you notice, for the contribution, you're going to look at the annuity table, 1 to 15. For the fixed cost, you're going to look at the annuity table, 1 to 15. But for the scrap value, you're going to look at the present value table, because it's not 1 to 15, it's just the year 15 you sell it. You didn't sell it 15 years in a row, because it's one item, right? You sell it in year 15 alone. So it's a present value table you use. Then the sum of the present values will give you the NPV. First, you want to see if the project is worthwhile. Then we will look at the sensitivity. So even before looking at those numbers, we have 5 things that ask us to assess sensitivity: the initial investment, the sales volume, the fixed costs, the scrap value, and the cost of capital. Now, the formula above the example says that sensitivity is equal to NPV over present value of the flow considered times 100, meaning we work out in a percentage. So the NPV of the initial investment, for example, sorry, the sensitivity of the initial investment is going to be the NPV, whatever it is, over the initial investment, the 150, for the present value, which is the present value column, times 100. For the sales volume, it's going to be the NPV. If you notice, the NPV is always a numerator. No matter the bigger or smaller than the number, the NPV is always, always, always the numerator, right? And then you put it over the present value of the flow being considered. So the present value of the initial investment, the present value of the contribution, which is basically related to the sales value, the present value of the fixed cost, the present value of the scrap value. Now, the present value of the cost of capital, you wouldn't say that pretty much is the IRR. So if they ask you the sensitivity of the cost of capital, remember, sensitivity is trying to work out how much can this variable move by for you to break even. Like if you move by more than that, you're not going to do it. Now, sensitivity of the cost of capital would mean the IRR. The IRR is the cost of capital at which the NPV is 0. Anything higher than that, you're going to go into negative. So those are some points, but let's not look at the numbers, because that's why I gave you the time to look at the numbers itself. Well, let's not look at the numbers. All right. So as we said, initial cost, the contribution, the fixed cost, the scrap value. So we have a positive NPV of 5,329. So the project makes sense, right? So from this perspective, the project makes sense. However, how much can the initial investment change back for your decision to change? So it's going to be the NPV by 329 over the present value of the initial investment, 150 times 100. So that's 3.6%. What does that mean? It means that the cost of the asset can go up by as much as 3.6% and I'll break even. But if the cost is more than that, so suppose you went and the demand is 150 for it. When you go there, you run out, you don't have any. The next place you go is 156,000 for it. And you say, voila. Our workout, you know, the highest I can pay is $155,329. Right? Because only 3.6% is the maximum I can accept. If it's higher than that, I'm going to lose money. Doesn't make sense to invest in it at all. So that means that the car can go up by as much as that. But the sensitivity of the sales volume now, you're going to use again the present values. The present values we're going to use. So the present value of the contribution is 241,189. So NPV over the PV of the contribution times 2.2%. What does that mean? It means that the sale can fall by 2.2%. But if it falls by more than that, you lose money and it don't make sense. Right? You can even work it out in terms of units, but we don't need to do that right now. So what we're really saying that if it falls by more than that, the sales is going to decline by more than that, then do not then reject the project. Fixed cost is similar. The NPV over the present value of the fixed cost. The present value of the fixed cost is 87,705. So that's approximately 6%. It means then the fixed cost can increase by up to 6% and you still are okay with it. But if it increases by anything more than that, you would reject the project. The scrap value, the sensitivity of the scrap value, the NPV over the present value of the scrap value. Now, some people in the world, they saw them 289%, but that doesn't make no sense. But what it is saying really is this, that even if you don't, even if you see right now, the present value of what you sell the asset for is 1,845. But even if you didn't get any money at all for it, it's not relevant to the project. I am 5,329, right? So any figure less than 5,329, doesn't make sense, it doesn't make no difference. It's not relevant. So the scrap value, even if you didn't have to sell it, you have to just dump it, it's not relevant to the project. 3 days. If you have to dump it, the project will still make money. And last but not least, is IRR. Cost of sensitivity to the cost of capital, you have to work out IRR. So choose any other discount rate. You just choose any one you feel like you want to choose, right? So they use one before, but choose any one you feel like to discount all the cash flows, get an NPV, and work out the IRR. Because that's what they're asking, work out the sensitivity. The expected value question, I'm not going to work that one. Because that one is very expected values is straightforward. You can look at the example and you should be fine with that. And the third final example on the handout is discounted payback. All it is payback, but then of course discounting the cash flows to their present values. Right, that's really what. So let me just go quickly on the example for wrap up this handout. Okay. As I said, I'm going to look at the second one. So this is some notes and simulation advantages, disadvantages, no calculation for that. The exam, what are the advantages, disadvantages of using the expected value approach, and then discounted payback. All it is really is discounting the cash flows, right? So we discount them. So that's really what it entails. So you have the cash flows, discount them, get the PVs, and then work out the cumulative balance based on the present values. And then, of course, you're going to work out the discount similar to how you work out payback in general. And that basically covers session 6 handle. What I'm going to recommend you do is ensure that you are caught up with all the sessions. Go back to your notes, do the examples that we probably didn't do. As I said before, the handbook that you have that says the F9 study system. It is so all the notes that you have, session 1 handout, session 2 handout, and then at the end of each of those, the solutions are actually there. So the solutions I'm showing you are actually solutions in the textbook. At the end of each chapter, the solutions are at the back. So please ensure you catch up with your notes. Having sessions left, our first revision session will be on Easter Monday, April 6th, starting at 9:30. I said 9 before. We work with 9:30 until 6 p.m. So that's what we're going to be doing. We're going to be working through the first 1.5 of the session. We'll be doing the final topic, which is risk management. And then after that, we will be focused on question practice. Right? That will be the focus. The main area we're going to be focused on the investment appraisal, cost of capital, and risk management, potentially working capital management as well. So the three main ones would be investment appraisal, for investment appraisal, cost of capital, and risk management. So just in case you need to prepare, as I said, working capital management will be included as well. Not really, because we will be doing other sessions on that. So we will give you an outline detail of the revision sessions to come starting April 6th. That was sent out by the last tutorial session that we will have on March 31st. That will be the last tutorial. The other 5 or so sessions will be mainly revisions. So if any questions or clarification, you can voice them. If not, then we can end here. But please ensure you catch up, get caught up with your notes. Just at least at the bare minimum. I don't need you reading ahead. I need you to ensure that you have understood what we have done so far. Any questions, then you will just let me know. All right, so we're good to go. No questions, no clarification. This is where we end. So take care, everybody. Until Monday. See you then.